In this video, we shall understand the decentralized finance applications on the Ethereum blockchain. First, we will be introducing DeFi and its key principles. We will look at its key components, including decentralized exchanges, lending and borrowing platforms, etc. We will also introduce some of the most widely used and influential DeFi protocols. We shall then build a simple DeFi application and also understand smart contracts in DeFi. We will then discuss the need for oracles in DeFi applications. We will then look at liquidity pools and automated market makers and explain the principles of staking and yield farming. Decentralized finance is a term used to call a variety of financial services and applications built on the blockchain technology. These services are decentralized, meaning they operate without intermediaries like banks. Its main features are it is decentralized. It is more accessible since everybody has a phone now. It has more interoperability and it is very transparent considering all the data is on a public blockchain. DeFi is like a peer-to-peer lending club where members can lend and borrow money directly from each other without a bank. The key components of DeFi are like various financial services offered by traditional banks such as currency exchange, loans, and investment products. These include decentralized exchanges, lending platforms, stablecoins, and synthetic assets. Decentralized exchanges allow users to trade cryptocurrency and other digital assets directly with each other without the need for a centralized intermediary. This provides more control and transparency for traders. Lending platforms enable users to borrow and lend cryptocurrencies, earning interest on their holdings. Stablecoins are cryptocurrencies pegged to real-world assets like the US dollar, providing price stability compared to volatile cryptocurrencies. Synthetic assets are digital representations of real-world assets like stocks or commodities that can be traded on DeFi platforms. Popular DeFi protocols are like popular financial institutions, each offering unique services to the users. We will introduce popular DeFi protocols such as Uniswap, Aave, Compound, and MakerDAO. Uniswap is a decentralized exchange protocol that allows users to swap ERC20 tokens. Aave is a lending and borrowing platform that enables users to earn interest on their crypto assets or borrow against them. Compound is a money market protocol that allows users to lend and borrow cryptocurrencies. MakerDAO is a decentralized stablecoin platform that issues the DAI stablecoin and provides lending and borrowing services. So, developing a simple DeFi application is like creating a peer-to-peer lending system where participants can lend and borrow directly from each other. This contract is a simple example of a decentralized lending platform. There is a deposit function which allows users to deposit either into the contract. Then there is the borrow function which allows the user to borrow from the contract. Then the user can borrow up to the amount they have deposited. The repay function allows user to repay the loans by sending either back to the contract. The get loan function returns the current loan balance. Smart contracts play a crucial role in DeFi applications. They automate and enforce the rules of DeFi protocols, ensuring trustless interactions between participants. Smart contracts in DeFi can be likened to automated legal agreements that execute themselves when predefined conditions are met. Oracles play a crucial role in DeFi applications by providing external data such as price feeds to smart contracts. They act as a bridge between the blockchain and the real world data that DeFi applications need to function effectively. To illustrate the importance of the oracles, we can just think of them as financial news services providing real-time market data to trading platforms. Just as traders rely on accurate and up-to-date information from these services, DeFi applications require reliable data from oracles to make informed decisions and execute transactions. One popular oracle solution is Chainlink, which allows DeFi applications to securely access real-world data and off-chain computations. Here is an example. We first import the aggregator interface from the Chainlink contract library. We then declare price feed as a state variable of the type aggregator v3 interface. We then utilize a constructor that initializes the price feed with the address of the Chainlink price feed. In this example, the given address corresponds to a specific price feed. The function getLatestPrice calls the latest round data function from the Chainlink price feed to get the most recent price data. The function extracts the price from this tuple and returns it. Liquidity pools and AMMs are like community-owned stockpiles where traders can buy and sell goods directly from the pool based on dynamic pricing algorithms. Liquidity pools are decentralized exchanges like Uniswap, which rely on liquidity pools, which are community-owned stockpiles of digital assets that are used to facilitate trading without traditional order books. Automated market makers or AMMs are algorithms that power the pricing and trading in these liquidity pools, allowing for dynamic and automated market making. Staking and yield farming are like earning interest or dividends by depositing money in a bank or investing in stocks. They allow users to earn rewards by providing liquidity or staking their tokens in DeFi protocols. By staking their tokens, users can earn rewards in the form of additional tokens or a share of the protocol's fees. Yield farming involves actively managing one's liquidity provision across different DeFi protocols to maximize the rewards earned. Security in DeFi applications is of paramount importance, just as having robust locks and security systems is crucial to providing valuable assets in a vault. Developers must prioritize security measures to safeguard users' funds and maintain the integrity of their DeFi protocols. Best practices include conducting thorough code audits, utilizing security tools, and following secure code practices to mitigate the risks of vulnerabilities and exploits. Code audits are essential to identify and address potential security flaws before deploying a DeFi application. Security experts should thoroughly review the codebase, scrutinize the smart contract logic, and ensure that the application is free from common vulnerabilities such as reentrancy attacks, integer overflows, and unauthorized access. By addressing these issues early on, developers can significantly reduce the risk of costly and damaging security breaches. In addition to code audits, DeFi projects should leverage security tools and frameworks to enhance their defensive capabilities. These tools can help detect and prevent a wide range of security threats, including front-running attacks, price manipulation, and flash loan exploits. By integrating these security measures, DeFi applications can better protect their users and maintain the trust of the broader ecosystem. Secure coding practices are also crucial in the DeFi space. Developers should adhere to industry standard guidelines such as those outlined in the Ethereum Solidity documentation to ensure that their smart contracts are designed and implemented with security in mind. This includes following best practices for access control, error handling, and data validation, among other considerations. So, we learned that DeFi enables decentralized financial services without intermediaries. Key components of DeFi include DXs, lending platforms, stablecoins, and synthetic assets. There are popular DeFi protocols including Uniswap, Aave, Compound, and MakerDAO. Developing a simple DeFi application involves creating smart contracts for lending and borrowing. Oracles provide essential external data to DeFi applications. Liquidity pools and AMMs facilitate trading in DEXs. Staking and yield farming offer opportunities for earning rewards. Security is paramount in DeFi, requiring through audits and best practices. Here are some exercises you can solve.